You probably think you understand debt. A necessary evil, perhaps, a tool for growth, maybe a choice you make, consciously, to acquire something now and pay for it later. But what if I told you the very mechanism that drives trillions in global consumer spending today? The credit card was unborn out of careful market research or widespread public demand, but from a desperate, secretive gamble. A financial bomb dropped on an unsuspecting American town that sparked chaos, fraud, and utter panic. And in its wreckage, forged the invisible chains that bind modern economies. This isn't a story about the ingenious invention of a convenient payment method. This is the story of Fresno, California, 1958, a seemingly ordinary town that became the unwitting petri dish for a radical financial experiment. An experiment so reckless, so audacious, that it nearly brought down a bank, baffled law enforcement, and left a trail of ruined lives. Yet, from its ashes, emerged the blueprint for every credit card in your wallet today. The Fresno Drop was less a market launch and more a financial insurgency. And its lessons about human nature, corporate ambition, and the true cost of convenience still echo louder than ever. Part 1. The Banking Enigma, a giant under siege. To understand the madness of the Fresno Drop, we first need to understand the behemoth behind it. Bank of America. In the mid-1950s, Bank of America wasn't just a bank. It was the bank in California, a sprawling empire built on aggressive expansion and innovation, particularly in consumer lending. They pioneered car loans, home mortgages, installment plans. They were masters of moving money, but they faced a growing problem. Post-war America was booming, but consumer finance was still largely fragmented. People had store credit at individual shops or department store charge cards. Cash and checks were king. These systems were clunky, inefficient, and crucially for banks didn't offer a consolidated, easily trackable revenue stream for small, everyday purchases. Banks were missing out. They wanted a piece of the pie, a system that could handle thousands, even millions, of small transactions, reliably, profitably. The Holy Grail was a universal charge card. Some attempts had been made, like the Diners Club card, but these were primarily for business expenses and required paying the full balance each month. Bank of America envisioned something far grander, far more insidious, a card that allowed you to carry a balance, month after month, generating interest for the bank. A truly universal, revolving credit. The challenge was immense. How do you convince merchants to accept it? How do you get customers to use it? How do you manage the immense logistical nightmare of processing millions of tiny transactions? The answers weren't obvious, and time was running out. Smaller banks, ever eager to chip away at BOA's dominance, were starting to flirt with their own charge card experiments. BOA needed to move, and they needed to move fast. The stage was set for a desperate gamble, a secret project, codenamed Operation Sparkle, led by BOA Vice President Joseph P. Williams. Their chosen testing ground, Fresno. Why Fresno? It was a medium-sized city, geographically isolated, with a diverse economy, and critically a population that mostly banked with Bank of America. It was, in their minds, the perfect microcosm of America, a place where they could deploy a radical new financial weapon without alerting the entire nation, or so they thought. Part 2. The airdrop, a card in every mailbox. On September 18, 1958, the unsuspecting residents of Fresno began to receive a peculiar item in their mailboxes. It wasn't a flyer, a bill, or a personalized letter. It was a crisp, new plastic card, about the size of a driver's license, emblazoned with bank. In crucial detail, it was already activated. Attached was a letter explaining this new convenience, a list of participating merchants, and a pre-approved credit limit, typically $300, roughly $3,000 in today's money. This wasn't an offer for credit. It was credit, delivered unbidden, directly to their homes. In a single day, Bank of America airdropped 60,000 such cards into Fresno. No applications, no credit checks, just ... credit. The theory was simple. If you make it effortless to acquire and use, people will. This bold, almost arrogant, strategy was designed to instantly create market penetration, overwhelm competitors, and establish Bank of America's dominance in the burgeoning consumer credit space. They were betting on convenience, trumping caution. The initial response was a mixed bag. Some residents were bewildered, even suspicious. Why are they sending me this? Is this a scam? Others, however, saw immediate opportunity. Post-war America was a society increasingly geared towards consumption. The American dream was tied to acquiring homes, cars, appliances. But most working-class families didn't have huge savings. The BankAmericard offered instant gratification, a way to bridge the gap between desire and cash in hand. Merchants initially hesitant were offered incentives to accept the card, eager to tap into this new potential customer base. For a brief, intoxicating moment, it seemed like a stroke of genius. The cards were being used. The transactions were flowing. Bank of America had ignited a financial revolution. But beneath the surface of this newfound convenience, a storm was brewing. A storm born of human nature's darker impulses, a storm the architects of the Fresno Drop had catastrophically underestimated. Part 3. The breaking point: chaos, fraud, and ruin. Bank of America had focused on the logistics of distribution and transaction processing. They had not, it turned out, focused nearly enough on the psychology of giving unsolicited credit to thousands of people, many of whom had no credit history, or worse, a questionable one. The Fresno Drop quickly devolved into an unmitigated disaster. The cards, mailed to generic addresses, often fell into the wrong hands. Porch pirates had a field day. People found discarded cards and simply began using them. With no photo ID on the early cards and lax verification processes, fraud exploded. But it wasn't just criminals. Many ordinary citizens, suddenly flush with an unasked for $300 credit limit, simply couldn't resist. They bought goods they couldn't afford, convinced they'd somehow make it work. Small businesses, desperate for sales, often accepted the cards without proper verification, only to be left holding the bag when the bank refused to pay for fraudulent purchases. Within weeks, Bank of America's processing centers were overwhelmed. Unpaid balances skyrocketed. Fraud losses mounted at an alarming rate. Joseph Williams, the architect of the project, later recounted how their carefully laid plans crumbled. They had projected a loss rate of around 4%. The reality, it soared past 20%, even 22% in some estimates. The Fresno Drop was hemorrhaging money. The ripple effects spread through Fresno like wildfire. Police departments were inundated with reports of credit card fraud, a crime they barely understood how to investigate. Small businesses faced bankruptcy. Families found themselves trapped in cycles of debt they never asked for, their credit ruined, their homes suddenly vulnerable. The initial promise of convenience had curdled into a bitter cocktail of panic and regret. The grand experiment wasn't just failing, it was actively destroying trust, devastating individual finances, and threatening the very reputation of Bank of America. Part 4. The aftermath and the accidental breakthrough. The Fresno Drop was a humiliating, expensive fiasco. Bank of America lost an estimated $20 million, $200 million in today's money in just over a year. Joseph Williams was eventually removed from the project. It seemed like the universal credit card was a pipe dream, a dangerous fantasy that risked the stability of established financial institutions. They tried everything: stricter limits, more rigorous verification. But the damage was done. The initial reckless airdrop had created an unsolvable problem with the existing infrastructure. Yet, in the midst of this chaos, a strange alchemy occurred. The very scale of the disaster forced Bank of America to innovate at an unprecedented pace. They had to create entirely new systems for managing risk, for processing transactions, for identifying fraud patterns. They had to learn, in the harshest possible way, how to manage mass consumer debt. This meant developing sophisticated algorithms, though they wouldn't have called them that then, for calculating risk scores, creating extensive merchant networks, and critically, understanding that the revolving credit model, despite its initial pitfalls, was enormously profitable if managed correctly. The Fresno Drop forced them to forge the tools and protocols that would become the backbone of the entire credit card industry. They learned that a single card issued without application was disastrous. But a card issued after an application and credit check could be a goldmine. Bank of America didn't abandon the BankAmericard. Instead, they took the bitter lessons from Fresno, refined their approach, implemented stringent application processes, and slowly, cautiously, began to roll out the card across California, and eventually, nationwide. Other banks, initially mocking BOA's failure, watched closely. They saw the potential profit margins, the sheer volume of transactions. And so, the concept of the unsolicited, activated card died. But the idea of the universal revolving credit card was perfected, forged in the crucible of Fresno's financial chaos. By the late 1960s, the BankAmericard, which would eventually become Visa and its rival, the Interbank Card Association MasterCard, were firmly established. Part 5. Echoes in the Digital Age, the Legacy of Recklessness. The Fresno Drop happened over 60 years ago, but its lessons resonate powerfully today. We live in a world saturated with credit. Global credit card debt stands in the trillions. Revolving credit is not just a convenience, it's a fundamental pillar of modern economies. But the same impulsive human nature, the same corporate drive for market share, and the same unforeseen consequences that plagued Fresno still exist. Consider the rise of buy now, pay later, BNPL services. These often offer instant credit at the point of purchase, frequently without rigorous upfront credit checks, and sometimes to a younger demographic less familiar with traditional credit. Does this sound familiar? It echoes the ease of acquisition that defined the Fresno Drop, simply updated for the digital age. Or think about pre-approved credit card offers that flood your mailbox, a refined, regulated descendant of BOA's original airdrop, now vetted by decades of accumulated data and risk assessment. The fundamental human impulse to acquire, combined with the ease of instant gratification, remains a potent, often dangerous, mix. The Fresno Drop was a raw, unrefined experiment in human financial behavior. We saw then, as we see now, that when access to credit is too easy, when education around its risks is insufficient, and when the allure of instant purchasing power is overwhelming, the result can be widespread financial distress. The systems we built to manage this behavior, credit scores, interest rates, regulatory oversight, are direct descendants of the painful lessons learned in Fresno. But are they enough? The credit card, born from that chaotic experiment, has undeniably fueled unprecedented economic growth and personal convenience. It allows for global commerce, emergency funds, and the frictionless pursuit of desires. But it also creates a hidden pressure, a quiet vulnerability. It shifts us from a society of savers to buy to a society of buyers to pay. And that shift, initiated by a reckless gamble in a small Californian town, fundamentally changed our relationship with money, with aspiration, and with ourselves. Conclusion: the indelible mark of Fresno. So, what are the enduring takeaways from the Fresno Drop? 1. Innovation through catastrophe. Sometimes the greatest financial innovations are born not from brilliant foresight, but from the desperate need to fix colossal failures. The credit card we know today was forged in the crucible of Bank of America's near-catastrophic misstep. 2. Human nature is constant. The core impulses of immediate gratification, the struggle with temptation, and the allure of free money haven't changed. Financial products and services can amplify these impulses, leading to predictable patterns of boom and bust, regardless of the technology. 3. The invisible architecture of debt. The credit card fundamentally rewrote the social contract around money. It normalized revolving debt, making it an almost invisible, ubiquitous part of daily life. This silent revolution, begun in Fresno, continues to shape our spending habits, our economic stability, and our financial futures. The Fresno Drop was a chaotic, expensive, and ultimately formative chapter in the history of finance. It taught us that convenience, when unchecked, can be a dangerous master. It showed us the immense power of accessible credit to transform not just individual lives, but entire societies. So the next time you swipe, tap, or click, remember Fresno. Remember the chaos, the ingenuity, and the silent revolution that began with 60,000 plastic cards, dropped into the mailboxes of an unsuspecting town, forever changing how we spend, how we save, and how we live. What are your thoughts on the legacy of the Fresno Drop? Has our relationship with credit evolved for the better, or are we still falling prey to the same fundamental impulses? Let me know in the comments below. If you found this dive into financial history illuminating, please like this video and subscribe to the channel for more stories that uncover the hidden forces shaping our world.